Hi there and welcome. This is Roger at SwiftCloud. We deal with business owners and investors all day, every day. What you're about to hear is an excerpt from a longer conversation with Bruce Mack. Bruce is the founder of the Platinum Group, which includes the Platinum Trust Group and the Platinum Financing Group. And he and I have been friends for several years. So we started as an agency originally, and throughout that relationship, we've had some great times. We've made some great projects, and I've heard some crazy stories come up over the years of his clients. And I wanted to get him on the call and talk about basically some of those stories and how his systems can help business owners and investors, which might be you, save money, protect their assets, and advance their career and basically take care of things and ascend that hierarchy from stability to success to significance. Now, this information can help you save hundreds of thousands of dollars or even millions of dollars throughout your career if you're an investor, if you're a business owner, that might be a real estate investor, whether it's crypto, whatever it is. Now, before we dive in, I want to tell you who Bruce Mack is. He's the founder of the Platinum Group, which includes Platinum Trust Group and Platinum Financing Group. He's a licensed financial advisor. He has flipped over 160 homes, totaling more than $92 million in value. He's a published author of several different books. He's an accomplished stage speaker and has shared the stage with leaders such as Al Gore and Donald Trump. Before we dive into this, a quick disclaimer. This presentation includes financial discussions and is not to be construed as financial or legal advice. Please note, in this discussions, we use the word save, which refers to the financial and tax implications within a given year, and more accurately refers to tax deferral in perpetuity pursuant to Internal Revenue Code Section 643. For formal tax advice, we recommend you seek the services of a duly licensed professional. Please refer to the complete legal disclaimer at the bottom of this page in which this video is embedded for more information. Hi there and welcome. This is Roger at SwiftCloud. We deal with business owners all day, every day. So Bruce, if there was a guy that owned a house, he's like 120 houses, two apartment buildings, something. What was that whole? Tell us about that guy.
No sweat, Raj. There was this guy, married, very successful. The couple actually owned 140 single-family residences and two apartment buildings. And they were on top of the world financially, emotionally, and any other way you can think of, until one day they got hit with a lawsuit from one of their tenants, which, even though they had LLCs, they unfortunately ended up losing everything. Millions and millions of dollars worth of wealth was wiped out that quickly.
And obviously the LLC didn't work. What about insurance?
Well, insurance is great, and everybody should have liability insurance. And I strongly suggest that they have an umbrella policy as well. But there are many things that umbrella policies don't even cover. For instance, they're not going to cover a $6.9 million dog bite, a $49 million car accident, asbestos claims that we've seen for cottage cheese ceilings that need to be removed. I've seen $20 million, $30 million lawsuits, $13 million lawsuits for things like mold remediation. So these are what I call the big bingos, the big I gotchas that would never be subjected to a judgment or lien with a properly constructed trust like we've got.
Bruce, I know a lot of investors and business owners have a corporate entity, even multiple entities. Isn't that sufficient for asset protection?
That's a great question, Roger. I get that all the time. And the answer, quickly, sharply, and emphatically, is abso-freaking-lutely not. Because by definition, small business owners are solopreneurs. They may have a partner. They may have a spouse. However, because they are tightly held, it's extremely easy. And it's a third-year law student allegation to prove that they can pierce the corporate veil because they have a tightly held entity. The argument that's used is that alter ego, and they're really saying that they're like a puppeteer and that they are controlling the marionette, which is them controlling them, and it will blow up an entity. And once you blow up an entity, you're inside and you can take all the contents. Now, the idea of having a single entity for a single property or a single group of stocks or what have you is great. And then having separate entities for separate properties, that's great. But if you can make that argument at one time, you can make it for multiple ones. And the other idea that many people that we see, they try and utilize the holding company strategy where they have a holding company maybe in Nevada or Wyoming, and they figure that that's going to give them even more insulation from possible suit. And the fact is, it's another hoop to jump through. But if somebody sees a pot of gold at the end of the rainbow, believe me, they're willing to jump through that additional hoop. And again, once they get in, they can get it all. So Roger, this is where trust comes in, because one trust does it all. Every property, all your assets, I call them your planes, your trains, and your automobiles, everything goes into the trust, and everything is absolutely protected, where you do not need an entity. And frankly, what we advocate is that everything goes into the trust, and everything is therefore absolutely asset protected. That's your planes, your trains, your automobiles, your stamp collections, your properties, your stocks, your bonds. It all goes into the trust, and it's all completely protected at the highest degree. So therefore, there's no need for one entity, let alone multiple entities, which you're also paying for on an annualized basis, all the filing fees and the compliance and the oversight, i.e. the formalities, which could be another problem and another exposure for getting your entity blown up and therefore becoming what's called a disregarded entity. What I'm saying, Roger, is that they cast the entity aside because they crack into the corporate and pierce the corporate shell to get at any and all assets that are contained within, and or do that multiple times if you have multiple entities. It's that easy and simple.
Let's say hypothetically, listening to this call, that you're maybe a business owner. Maybe you've got solid income and you're concerned about taxes. And you're like, okay, if these guys can save me some real money on taxes, I'll listen. I'll invest just a little bit of time and find out if this is, worth pursuing, right? Let's say you're concerned maybe about transfer of wealth. Let's say you're interested in asset protection. You've got, assets less than that. Let's say you're still building your career. No problem. Bruce, I'm sure, has other options for you, as well as financing. But for today's call, we're going to really focus on asset protection and tax mitigation and that kind of thing. Tell me about this case study here on the screen, if you would.
Well, this is a case study of a doctor that we were working with. We have a number of doctors and dentists that are clients of ours. And in this particular case, this client was looking at a tax liability of $127,583. However, when everything was said and done, the bottom line of that client ended up being $15,143. Obviously, this was a substantial savings. And if you were to take that 15,000 versus 127, and let's just say in rough numbers, obviously over $100,000 a year.
So, and this is for a business owner, which I think a lot of the people on the call do own a business, and that business might be a lot of things. It might be a real estate business.
And in the case of a real estate investor, it's all lease and rental income or short and long-term capital gains. But this person is a doctor, and as such, these are the numbers. Actually, if it's passive income only, the numbers can even be more significant. That is the percentage of savings.
Wow, that's fantastic. And then there's going to be some people that have, let's say, a mix of both. So you mentioned, like in our case, Swift Cloud, right? So some of our clients up front were doing a bunch of setup work, and we would consider that active income. But after a while, those people are set and stable, and they just keep paying. Then technically, that would probably be designated as passive income. I don't know. I'll have to talk to our tax team about that. But yeah, that's exciting.
Absolutely. And then you've got rental income that we've talked about in the past that's in your portfolio, which would also be passive income from properties that you own. So yes, invariably you would need two trusts, a business and a business trust, which by the definition is two trusts. It's a business trust and a beneficial trust versus strictly just a beneficial trust. Several things that keep people up at night. They are not enough cash flow, paying too much in taxes, and the fear of losing your business and assets, Roger. And we do have solutions for all of those three scenarios. Our 0% APR funding program is a great way to solve cash flow issues. Paying too much in taxes, well, our copyrighted trust is a perfect solution for the right types of income. Again, it's not right for all types of income, and we will specifically detail what types of income fall into how we can help mitigate on taxes and which ones we can't. And losing your business and your assets, well, that's something that everybody has to be, wants to be, and should be concerned with, because aren't we all here to be able to create a legacy for our family that endures generationally? Well, if you get wiped out because of one bad actor and a horrible lawsuit and the crushing results that could be a part of that, then there is no legacy and you have to start all over again. And we want to ensure and assure against that ever happening in the future. And with our proprietary copyrighted trust, we absolutely have the answers there.
What is a trust? Assume that I know nothing. I've heard of trusts, and I've heard of these Kennedy dynasty trusts. I've heard of, like kind of these wealthy families. I have a few friends that are wealthy that have trusts.
Our trust has its roots in the dynasty trust, which has been around for over 100 years and has been used by the Kennedys, the Carnegies, the Rockefellers, and cost hundreds and hundreds of thousands of dollars. We now have a trust that is affordable, and it's ideally suited for entrepreneurs as well as investors. Let's start with some definitions so people understand what it is that we're talking about. And the first definition is that a trust, it's a contract, Roger, between the grantor and the trustee and the beneficiaries, which are three separate and distinct people, but in certain cases and in certain trusts, they can be the same person. So I look at the trust as truly giving you the ability to create a whole new rule book. So Roger, there are really two main types of trusts. One is called a testamentary trust, and it's really referred to in the industry as a death trust. It's created in a will and does not exist while alive, and it will require probate, which is a court proceeding, which is also expensive, and that is monies that is taken out of the proceeds of the estate to pay for it. So probate is something you always want to avoid at all costs, because you can end up losing a sizable piece of the estate. With a death trust, the unfortunate reality is for just exactly what it says. It does not even kick in until the person expires. And if there are needs that are that need to be provided for while living, unfortunately, and depending upon how it's written, likely they will not be there and to be able to take care of things like potentially long-term health care or other financial needs and or crises that come up. Very problematic. Then there are living trusts. So first one is a testamentary trust, and then a living trust versus a death trust, which exists during your life. It avoids probate. And there are really then two different types of living trusts. There are revocable ones and there are irrevocable ones. And we will talk about and focus on the better of the two, which is the irrevocable one, because with an irrevocable, specifically designed type of trust like we've got, you have the quintessential and pinnacle of asset protection that cannot be taken apart. Revocable trusts, again, no asset protection. Irrevocable trusts, asset protection. Now let's talk about, as long as we're talking about asset protection, Roger, let's talk about entities that people are under the common misconception that because they have an entity, a C, an S, or an LLC, is going to provide them with the absolute best asset protection, and that's therefore they have nothing to worry about. Well, this is a common fallacy and a misconception. We want to talk about the solution, and our solution is the Titanium Vault Asset Protection and Tax Reduction Trust. It has many different components, but we're going to drill down on several of the key components that are within our proprietary copyrighted trust: the non-grantor, irrevocable, discretionary, complex, and the spendthrift provisions. Rockefeller said it the best. The secret to success is to own nothing, but to control everything. And that's exactly what we want to have happen for you. where you're in that same role like Rockefeller.
Bruce, I hear all of this. Why don't more people have trust? What are the misconceptions stopping more people from getting a trust?
Well, there are three common misconceptions that we hear all the time. So let me address those. Well, one of the major misconceptions is that I can't use the funds that are in the trust. There's this misconception that the funds are locked up and the only people that have access to the funds are your heirs. That is absolutely not the case. And that is the case with self-settled trusts because the funds are ostensibly locked up and there is not the ability to administer and administrate like you can over our specialized proprietary and copywritten trust, where you have the ability as trustee, because it is not a self-settled trust, to administer for utilizing it for any trust business, and that gives you wide range. Heck, trust business can be buying a car. It can be doing anything on a business basis, making acquisitions of other properties, buying businesses, selling businesses, virtually anything. Matter of fact, there's only three things that are not the business of the trust that would become taxable distributions. Simply stated, food, fun, and fashion. So if it's not food, it's not fun, it's not fashion, it is business of the trust and all inclusive. And the trustee, which would be the person who's on this call invariably, has complete and total access to those funds. Second, the common misconception is that these are very complicated and more difficult to administer than my LLC, my C, or my S. Well, that just ain't so, because C's, S's, and LLCs all require that you have corporate compliance that needs to be followed. Otherwise, the entity can be easily blown up, and that there's also annual filing commitments and fees, none of which have to happen with a trust. You set it up one time, and frankly, you forget it. It's done once it's done. Third, that this trust or trusts in general like this are only for the uber rich. And I would agree with that in the olden days, because the uber rich were paying in the hundreds of thousands of dollars for the type of inclusivity that this trust has, and the asset protection and the tax mitigation capabilities for those who qualify. What we've done is we've designed our trust for most entrepreneurs as well as investors. Simply stated, that's what we do.
So when you guys take on a client, what is it to work with Platinum Group and Platinum Trust Group? So you don't just dump a kit into my lap and send me packing, right? It sounds like it's a little bit more involved.
It is a partnership is the way we look at it. We do hand-holding and we walk you through the entire process and give you the whys and the wherefores. And we're there every step of the way to ensure that both the setup as well as the implementation on an ongoing basis is being done properly. That way, the bottom line is win-win scenario for the client.
The next step to finding out if a Platinum Trust is right for you is to schedule your personal consultation. Take a moment and schedule your consultation today.